Hey guys, welcome back to the 10th episode of the Friday Ticker. In this episode, I want to cover how to sell covered calls when you're an owner of shares for a particular stock. So let's get into it. Now, let me first be clear, I am not a financial professional. I can't tell you what to do, when to do it, or how to do it when it comes to the financial markets. Selling covered calls is a complex, technical topic when it comes to the financial markets, and I definitely do not recommend trying them out if you don't have experience in the market. You definitely should have experience buying and selling shares before you even consider covered calls, and definitely do your research and get educated more than just someone like myself. There's lots of YouTube videos on this topic. I'm just another resource that may have some real world examples of how and why you would sell covered calls. So just be aware of that. And again, I'm going to stress, go long and strong in the stock market, okay, over a 10, 20, 30-year period. Selling covered calls is typically a short-term kind of trading strategy. It also is a hedging strategy, and I'll go in that in this video. So let's get started. Let's get started reviewing what a call option is, why would anyone buy a call option, and why would anyone sell one? Okay, so first, a call option is a contract, okay, between a buyer and a seller, and that contract states a specific strike price and an expiration date. Okay. And for example, we could go with maybe a strike price of $100 a share. We could go with an expiration date of, let's say, November 1st. Okay, that's around 15 days from today. Okay, so on the expiration date, if the price of the stock is above $100, that contract becomes valid, okay? And the seller of that contract is now obligated to sell at least 100 shares of stock at a price of $100. Okay, now if they only sold one contract, that would be worth 100 shares. Now, if they sold 10 contracts, okay, this is one. If they sold 10, this would be worth 1,000 shares, okay? So we're talking a bit more money there, right? We're talking about $100K worth if you sold 10 contracts at $100. Now, who are the buyers involved, and why would they buy option contracts? Well, the first kind of buyer, which is kind of your Robin Hood type of investor, they're the gamblers, okay? What they're looking for is leverage with an instrument that is going to give them a higher return rather than just buying the stock outright. And again, they're bullish on the stock in general. Now, the other type of buyer is someone who is hedging, okay? And they are hedging a short position, okay? They went short on the stock, okay? They want the stock to go down, but they're kind of scared. Maybe it's Tesla and they got short squeezed at some point. And so they buy some call options, okay? Probably a smaller amount in value than their short position because it's levered. And just in case the stock decides to go against them, they're at least going to make money on the upside to offset the losses on their short position. Now, why would you decide to sell calls in the stock market? Well, you're probably bearish on the stock. All right, maybe you've got a bearish thesis, maybe they had some bad earnings, whatever it may be. And so you're bearish, and you decide to sell calls because you want to collect some premium as the stock goes down, okay? Now, there's two ways to do this. You can do this by doing what's called a covered call, or you can do this with a naked call. Now, I highly recommend you never do a naked call. That means you don't own the shares whatsoever, and you sell a call option and you promise to sell shares to someone at that strike price. And I'll give you the reason why this is dangerous in a minute. So the one I recommend is doing a covered call. That means you own at least 100 shares of that said stock. Okay, you own it. You're okay with selling those shares at the strike price. All right, but let's go back to that naked call option there that I do not recommend. Okay, so let's assume that you actually decided to sell 10 contracts at, let's say, $100 strike price. Okay, and maybe you sold those contracts for, let's just say, $1,000, okay, in premium. For whatever reason, that's what the premium was. So you collected some money up front for that insurance policy that you sold. And let's say at expiration, maybe the stock closes at $101. Okay, so it did close above the strike price. So you are obligated to sell shares to the buyer of that contract. And here's the thing. You have to sell those shares at the current stock price, not the strike price, the stock price. So at $101. Even though you sold strikes at $100, you have to sell it at $101. Okay, so that's going to equate to $101,000. Okay? Now, the good news is that you sold at least $1,000 in premium, and you had to sell, or you had to buy stock worth $101,000, so you're at break even. Okay? Now let's look what would happen if the stock price closed a bit higher than $101. All right, so let's just erase this here. Again, you sold it for $1,000 in premium. You didn't own the shares. And now the stock price closes at $200. It goes crazy. It goes on this massive bull run. It closes at $200. Now you're on the hook to sell these shares at $200,000. Okay? You had $100K in your account that you assumed that you'd be okay because you didn't own the shares, but now you owe $200,000 to the broker, all for the $1,000 in premium that you collected. Okay, so in reality, you had $100K, you made $1,000, so you owe $99,000. Okay, this is the danger of selling naked calls. You don't want to do this, okay? What you want to do is sell covered calls, okay? Because since you own the stock, okay, it's a little bit different of a situation, okay? Let's take that same example. Let's say you own 1,000 shares of a particular stock. And again, you sell 10 contracts, which is 1,000 shares, all right, at 100 strike. 100 strike. Okay. And let's go with the same example. You sold $1,000 in premium. Okay, that's what you sold. Okay, you were incentivized by that premium. And now let's take that example of, hey, the stock price closes at $200. You're obligated to sell shares, but guess what? You own those shares. Okay, I don't know when you bought those shares. Maybe you bought those shares down at $50 a share. Okay? So now you're obligated to sell your shares at $100, okay? Which is equivalent to 100K. But you had 1,000 shares at $50, which means you only paid 50K. Okay, so you profited your 50K plus 1K for the premium, which means you made $51,000 in profit. Okay, even though the shares are trading at $200, you didn't have to lose out on $99,000 like the guy who sold the naked call option. Okay, and that's because you were limited by the upside. You lost out on potential opportunity. Okay, and that's what you give up when you sell call options. All right, you give up on potential gains for the $1,000 in premium. And so in a sense, it's a hedge for someone who's holding shares, guys. It is a hedge. And so you got to be careful about that. You know, for the 1,200 shares that I own of Tesla in one of my accounts, I never want to sell call options because I'm scared of losing out on this potential. Now, there are ways to mitigate that by selling deep out of the money call options. So let's say maybe Tesla is trading at, like today, it's trading around $400 a share. If I sold, let's say, I don't know, maybe $800 strike covered calls, you know, my odds of getting assignment and having to sell shares at $800 are probably really low. However, the premium I'm going to collect on that is like negligible, meaning it's only going to be like, you know, probably on, let's say 10 contracts, I may only sell them for probably $200. You know, is that worth my effort to sell covered calls and risk losing my shares at 800 share? It might be. You know, maybe I say to myself, hey, $800 a share is a good deal because I bought the shares at $15 and I'm fine with selling them at $800, right? But for some people, they may believe Tesla stock's going to $3,000 a share. So it's a risk you take in that you may not get any further upside. Now, you can always buy back the shares when you want after this thing goes for a crazy run, but it's a risk you take. So you got to be aware of that when you're selling covered calls. You might lose your position. Okay, that's the danger to it. Now let's look at a real world example of where I sold some covered calls recently and I'm in an active trade currently with Target stock. Now I'll give you just a little breakdown of how I got involved in the stock and then what I've done when it comes to selling covered calls. So, you know, I noticed this gap down from, I think it was earnings that had happened with Target. Okay, earnings weren't very spectacular, and Target stock opened way down here, right around the $94 level. Okay, so I was interested. I almost sold some puts right at the open, but I could. Sometimes with Fidelity, I can't even make a trade on options right at the open. It takes time for their electronic systems to work out and the bid and the ask to probably get all established on their trading platforms. And the stock just ripped right up. And as you can see, it ripped up that day, went higher. So I didn't get my opportunity, but I kept my eye on it and it started to trade down here a little ways. And I had a feeling it was going to retest that low that it had hit down here. And so, you know, right around this day, I sold 5 put options that day. Okay, so I was willing to buy the shares at a strike price of 98. Okay, and so that's 500 shares. That's around $45,000. Okay, and then, you know, the stock just goes way against me that day. and it kept going down. And so I said to myself, you know what? I'm going to double down on this. I want to collect more premium on my puts. So right around, I think it was this day, I sold, I think it was like a 90 strike price for another 5 puts. And I only sold them for like maybe $750. And so now I basically was obligated to buy 1,000 shares. And of course, the stock price went against me, kept going down, and eventually I got assigned these shares. So now I had to buy these shares at $98 and $90. Now, with all that being said, my average turned out to be $91.70. Okay, and I had sold these puts for almost $2,200. Sorry, $2,200 in premium. Okay, so even though I had to buy the shares at 98 and 90, that's a really high price there. But with all the premium that I had sold, it had brought my average down to 91.70. So I want to be clear about that on where my position lies when it comes to this trade. All right, so that everyone's aware. So my trade right now is I am, let's see, right around here. That is where my cost basis is, 91.70. So this whole time right here, I'm underwater. Okay, even like down here, I think I was down maybe $5,000. You know, each dollar I'm going down $1,000. So at 91.70, when the stock's trading here around 86, let's say 70 for a nice round number, I'm down 5K. Okay, but this is the kind of volatility you got to be willing to deal with when you're dealing with large positions. Okay, and I'm used to this. I've been doing this for years. And I am kind of bearish on target stock, but I do like the dividend. So if I get stuck holding the stock, no big deal. All right. So again, I'm at 91.70. Okay. And I just kept holding the shares here. I figured this was going to rally up. I mean, this was a big downward move. Eventually, you're going to get some short covering, and you'll get small pops and rallies in stocks typically. So I kind of knew that going in. So as it started to rise here, all the way up to here, it finally got up to around, it finally broke the $90 level again. And so what I did was I sold, let me erase this. I sold 10 contracts, my whole position size, at $95 strikes. So right at this level, okay, on this day right here, right at the top. I somehow timed it just perfectly. And I remember, like, see if you see, there's like a little tiny wick here. I sold it right at the top, and it sold off like into the close that day. So I felt really good about that. And I got a nice premium out of it. I got $2,100 in premium by selling right there. And then lo and behold, the next day, Donald Trump announces this 100% tariff on China. And so what happens? Boom. I think the next day, well, actually, let me take that back. The next day, it did sell off some because of that rally. And then this was Donald Trump's 100% tariff day, was right, this big red bearish engulfing candle. And I knew that this was probably going to get reversed over the weekend because that's how Donald Trump rolls. And the value of this contract, the implied volatility, had dropped so much because it was now trading around, $84. And that's $10 a share from $95. And so the implied volatility had went basically to nothing. And the value of this contract went from $2,100 down to around $1,100. And so I decided to close the position and buy the call options back on the open market. And that closes your position, And so I took $1,000 profit, okay, in 2 days. It was kind of crazy. I didn't really anticipate that. And so that was a pretty good trade. And so now I still own the shares, the 1,000 shares. And of course, I knew it was kind of going to roll back. And it did. Fortunately, we had this day right here. We had a nice, strong day. The stock was trading right around, I think it was $88. And I decided to go really far out time-wise at $95 contracts. And I ended up selling another 10 contracts right around here for $3,000, okay, in premium. And it's after earnings. And so that's why I think I got as much premium as I did. Because anytime you're selling options right after earnings, there's a ton more implied volatility. And so I was able to get a bunch of premium. And so now, here's what's interesting about that. Now remember, my average is $91.70. I sold $3,000. So that brings my average, no matter what, down to $88.70 plus the $1,000 I made from that quick 2-day trade. That now brings my average down to $87.70. Okay. And the other flip side to this is, let's say I get assigned the contracts at $95. This is where I sold these covered calls at. That means I've got a difference here of around $3,300. Is that what it is? Yeah, $3,300. So in total, if I were to get assigned in like 5 weeks, that's when I sold the contracts for. It's like November 22nd, I think. If I get assignment, total profit on this trade will be $7,300 approximately. You know, it's not exact math. I think it's pretty close to it. Now, however, let's say Target, let's erase all this. Let's say Target, somehow crushes earnings. Who knows? Maybe they had some good sales going on and people came in and they bought up all the goods at Target. Let's say earnings are good and the stock flies all the way back up to $105 a share. That could easily happen. This stock is down from like 50% year on the year, so it's in the doghouse as far as stocks is concerned. And whenever you have good earnings, this stock can go flying. All that money in between $95 and $105, for me, that would be $10,000. I'm going to miss out on. I'm going to miss out on it because I'm bearish on Target in general. And I collected my $3K as kind of like a hedge by selling all this premium. So I'm going to miss out on this $10K if it were to happen. Okay, that's not guaranteed that it will happen. Now, on the flip side, let's say the stock is trading around, $93. Maybe it's trading below that strike price. It could go down. It could go down to $80. And then I'd be down from my average of $87.70. I'll be down $7,700. I think that's right. Yeah. I'll be down that much, but at that point, I'm going to sell another call option, covered calls. I'll sell maybe another 3,000 if I can, maybe sell the $86 strikes. I don't know how much premium I would get. It depends on, again, volatility, how far I go out with those covered calls. So what's interesting about that, okay, is if you're really good at this game, you can continue to just sell covered calls, sell covered calls, sell covered calls. If somehow the stock just goes, like this, nice little sideways action for like 2 years, you could literally sell enough covered calls to make the shares free. If you were that good at selling option contracts, you could literally get your cost basis down to nothing. If you sold $3,000 every week, or not every week, but $3,000 maybe every 4 to 5 weeks, it might take you like 2, 3 years, but it's totally feasible. Now, odds are, to be able to do this over and over and over, you really got to have some fortunate price action that goes your way. Because typically you're going to get assignment and you're going to have to sell your shares, and then you'd have to go back to selling puts, which you could get right back into this cycle, no problem. But it is tricky. It's not a perfect science. I think it'd be kind of fun to get to this free point. We'll see what happens, but I don't anticipate that happening. The stock market is very volatile all over the place. And sometimes you can get trapped to where you can't collect that much premium. Like I said, if the stock were to go to $70 a share, now I'm really down. And I can't sell covered calls at $95 because they won't be worth anything. It would take me forever to gain any sort of premium. So you got to be aware of that. It is kind of tricky in general. But hopefully this helps you guys understand what selling covered calls is all about. And from my perspective, I use it as a hedge against a bearish stock. And, if I get lucky, I'll have a nice sideways stock and I'll just sell $3,000 in premium every 3 weeks, every 4 weeks. That would be great. But, we'll see what happens. So let me know if you have any questions about this in the comments below. I'd be happy to answer any questions or do further research on it. And if you guys could, like and subscribe to the channel if you like the content. And take a look at my previous video. And everyone, have a great day. Thanks. Bye.